Today's market action wasn't just a continuation of the rally. It reflected a shift in how investors are balancing geopolitical relief against underlying financial fragility. U.S. equities moved higher overall, but beneath the surface, the story was more nuanced. The S&P 500 gained just under 1%, and the Nasdaq outperformed with a stronger move higher, while the Dow lagged and closed slightly negative. At the same time, bond yields pushed higher again, with the 10-year Treasury moving back toward the mid-4% range, reintroducing pressure on valuations. In commodities, we saw a clear unwind of recent fear-driven positioning. Oil pulled back again, slipping below recent highs, and gold also declined after its sharp rally. Volatility continued to ease, with the VIX falling below the 19 level, a signal that near-term hedging demand is fading. So on the surface, this looks like a constructive environment, but what actually changed? The key driver today was a shift in expectations around geopolitical risk, specifically in the Middle East. Markets are increasingly pricing in the idea that disruption to oil flows, particularly through the Strait of Hormuz, may be avoided, at least in the near term. Shipping activity has started to normalize, and diplomatic signals suggest a temporary pause in escalation between Iran and Israel. That doesn't mean the situation is resolved, but it does reduce the probability of a worst-case supply shock. And that matters because just days ago, markets were pricing in a much more severe scenario, one where oil could spike aggressively and push the global economy towards stagflation. Now, that extreme outcome is being partially unwound. At the same time, inflation data remains elevated, largely reflecting prior energy shocks, so investors are now navigating a more complex picture where near-term risks may be easing, but underlying inflation pressures haven't fully disappeared. And this is where the market reaction becomes more interesting. Capital didn't just move back into risk broadly, it moved selectively. We saw strong flows into technology and consumer discretionary, areas that benefit from stable rates, improving sentiment, and lower input costs. In contrast, traditional cyclicals like industrials and materials underperformed, suggesting investors are not fully convinced about a broad economic acceleration. This kind of rotation tells you something important about positioning. It suggests that institutional investors are not chasing growth blindly. They are reallocating toward what you might call resilient growth. Companies with strong balance sheets, stable cash flows, and less exposure to external shocks. At the same time, financials showed some strength, hinting at expectations that central banks may be constrained, particularly if financial stability risks begin to re-emerge. And that brings us to a deeper layer of the story. Because while markets are reacting positively to geopolitical de-escalation, there are signs of underlying fragility, especially in the financial system. Recent data suggests that regional banks are still dealing with pressure from commercial real estate exposure. Liquidity conditions are tightening again in parts of the system. So even as yields move higher, there's a growing question: how far can they rise before something breaks? This creates a tension in the market narrative. On one side, easing geopolitical risk supports growth and lowers inflation expectations. On the other, higher yields and financial stress limit how aggressively policy can remain tight. One open question investors are debating right now is whether this environment represents a stable transition or the early stages of a more complex repricing of risk across assets. I'd be curious how you see this developing. Is the market becoming more resilient or simply more fragile beneath the surface? Looking at the bigger picture, today's moves suggest that markets are trying to stabilize around a middle ground. Growth isn't collapsing, but it's not accelerating decisively either. Inflation is moderating at the margin, but not fully resolved. and policy remains constrained between fighting inflation and preserving financial stability. In that context, market leadership becomes more selective, favoring quality, liquidity, and resilience over broad cyclical exposure. And looking ahead, the next phase will likely be tested by a few key variables. Any confirmation or breakdown in geopolitical stability could quickly shift the outlook for energy and inflation. Further data on inflation and central bank communication will shape expectations around rates. And importantly, signs of stress in the banking system or credit markets could reintroduce volatility very quickly. The broader takeaway from today's market reaction is that investors may be moving past extreme risk scenarios, but they are not returning to a simple growth narrative. Instead, markets appear to be navigating a more constrained environment, where stability depends on multiple factors holding together at once. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.